Hello and welcome to Livewire Markets. My name is Anna Dadic. Today I'm joined by Hollie Briggs from the Growth Equity Strategies team at Loomis Sayles. Hollie, let's start with how you see the world. Your team uses a strictly bottom-up research framework that doesn't rely on broad daily macro trends or sector trends. How do you train yourselves to completely ignore the daily macroeconomic noise and short-term market panic that distracts almost everyone else?
I really think it has to do that our philosophy and process has trained us to ignore those things. We are a long-term investor in businesses. We're highly selective, and we only want to buy those businesses when they're trading at significant discounts to intrinsic value. So our team is celebrating its 20th year anniversary at the end of this month, and we've used the same philosophy and process, our 7-step proprietary process, for that entire 20 years. The team has been trained and mentored in that process by the portfolio manager. It starts by having a long-term view. Your investment time horizon really informs how you view valuation, how you view sustainability and durability of growth. So that's really helps us ignore the day-to-day noise, as you call it. We're looking for these first high-quality businesses. We may be a growth manager, but we want to understand who's going to capture that growth. And that comes from businesses that have high barriers to entry, who have competitive advantages that are difficult, if not impossible, to replicate. We look for businesses that have business models that generate a lot of free cash. And then we want in management teams who think in terms of decades, who have that cash and can invest in ways that sustain and extend their own competitive advantages well into the future. And then once we find these companies, we want to see what their growth drivers are. So we're looking for structural growth. It can be something like the shift to cloud infrastructure. And even e-commerce globally has only penetrated retail spending by about 15% even now. So, having that long-term view helps us ignore the daily news. And then being patient investors, we wait for the price to come to us before we make an investment. But what I think is most interesting about the philosophy and process is really, where did it come from? Why do we think that way? And it's really because looking at the markets and really understanding that volatility is a feature of the market. It's not a bug that we can fix. So we want to embrace that as part of our investment philosophy and process. And we understand that market volatility is driven primarily by investor sentiment. And that investor sentiment triggers our behavioral biases. We have fear, we have herd mentality, call it FOMO today. I think one of the biggest drivers of high turnover is really the 24/7 news cycle. We're manufacturing headlines that are really clickbait, which trigger these behaviors. So it's really important, in our view, to recognize that's what's going on and really sort of embrace that volatility as part of what can give us an advantage. That type of overreaction will recur over and over again. And having seen it now for 20 years, we're patient to buy these high-quality growth companies, but when there's some sort of short-term headwind and consumer fear out there.
You typically look to buy and hold companies for 8 to 10 years, which is longer than most fund managers, I would say. So when it comes to discovering new stocks, what are the ingredients for long-term winners in the midst of massive technological disruption?
Right, so the ingredients really go back to our investment philosophy and process, and starting with that quality perspective. And it really is tied to having a long investment time horizon. But how do you identify those quality companies is a good question. And we take an approach where we look at the global value chain for every industry. What we want to come to understand is a structural understanding of the industry. How is value created and who is capturing that value? Many investors use screens, right? So screens can be comprised of different business characteristics, the financial characteristics really is what I'm thinking of, or stock characteristics. But the problem with using screens like that is that they're backward looking. And what we're trying to recognize are inflection points. And a screen isn't going to tell you if something that was doing poorly is about to do better, or something that was doing well is about to do more poorly. So I think that approach to really looking for the structural winners as the pool we want to fish in to begin with, I think helps us stay focused on that. But when you think about technological disruption, and it really is, it's one of the biggest technological transitions we're having right now with AI. I mean, it's not akin to the cell phone. It's, more akin to the internet for sure. And it's going to be in all of our lives, and it's hard to understand where that's going to happen. So part of understanding where to invest is not just new ideas. It's also about looking at the holdings that you have already. As you said, we own companies on average from 8 to 10 years. So you want to look at the companies you have in the portfolio to see if your long-term investment thesis remains intact. One company that's on people's minds today, where there's a lot of question, but one that we've owned in the global growth strategy since its inception 10 years ago, but in our large cap growth strategy for 20 years now, continuously, is Oracle. So there's a lot of concern around the investments they're making, the capital expenditures they have to build out AI infrastructure, and whether or not they're going to be able to return investment, they're going to make earnings on that investment. Here's how we look at Oracle. First and foremost, they have a large, profitable legacy business in database, right? It was responsible for the lion's share of their revenue. You look at their client retention, it's above 95%. They have a great sales force, a great service force, and all of the Fortune 200 companies and more are their clients. So they have a very strong, high margin, free cash flow generating business. And this infrastructure build out is really only the third CapEx cycle Oracle has engaged in over the last 50 years. And we think it's an important cycle. They are a database company. They process data. They really are a key person or key company to be engaged in that type of investment cycle. And we think it fits with their long-term competitive advantages. And they do have the strong business that will continue to generate operating cash, good margins, good top-line growth to sustain that over the long term. So that's an example where, yes, you're looking for new ideas, but you also want to make sure that the businesses that you own are properly structured to sustain through the disruption.
You currently own 6 of the Mag 7 companies, all of whom have had a very up and down 12 months. Take us through the bull case for some of these names, and as a follow-up, why doesn't Apple make the cut in your portfolio?
Good questions, both of them. So on average, we've owned those 6 companies for more than 13 years. So yes, you've seen a lot of volatility in the last 12 months, but let's go back to the time when the term Mag 7 was created. And it was actually, came into being after the magnificent performance in 2023. But in 2022, those same companies were among the largest detractors from the market returns. And when you look at those 2 years together, the cumulative returns of those 7 companies was about 8%. The annualized returns was just a little over 3%. And 3 of those companies ended that 2-year period in negative territory: Amazon, Alphabet, and Tesla, right? So we really do like to take a bigger view of that. These names like Mag 7, FANG, Nifty 50, Four Horsemen, there've been many over the decades, but they group together companies that really have nothing more in common than recent high-profile performance. And then what can happen is that a narrative layers in as though there's something else that brings them together. And I think what's happened with these companies is really they've been conflated as AI companies. I'm in meeting after meeting where people are referring to AI companies, but just like Oracle has a different business, Alphabet has a large legacy online advertising business. 75% of their revenue comes from online advertising, not AI. It kind of also goes with that question is, when is AI going to be monetized? Well, AI has actually been around for a long time. It's in all the algorithms and things too. But you look at a company like Alphabet, and they've been building tools that help content creators create YouTube videos more efficiently. They have tools to help advertisers do better targeting. They have tools for us to do more robust search solutions. So you see that monetization come through in higher usage, more advertisers, higher revenue per user, higher fees that they earn on advertising. So AI is part of the solution for their advertising business. They also have a cloud business. It accounts for about 18% of their revenue, and it's been around for more than a decade. And they are building out and improving the efficiency of that offering by adding AI power to a service that they've already been providing. And with the demand for AI being higher, they are building out more of that infrastructure. So you are seeing higher growth. I mean, top line growth for Alphabet, including all of their businesses, is still extraordinarily high, 20 to 30%. You would think the law of large numbers would have reduced that by now. So it's a very strong growth profile. You see their margins are good. And in the cloud business, you see about 60% growth year over year. So that's a much higher growth. So, all in, we see that this is a strong legacy advertising business. It's already earning money from AI, if you will, and it's building out the AI infrastructure, which supports a cloud services business that they were already investing in. So it's a logical extension, again, for us, and looking at their ability to make that investment through the cash they're already generating and their ability to earn returns on invested capital that's greater than the cost of capital. So, that's one bull case that we see for Alphabet. When it comes to Apple, Apple is a great company. It's realized a lot of growth over the years. But when we look at handsets from the quality perspective and the idea of something having a wide moat and being difficult to replicate, when Samsung first came to market with their handset quite a while ago now, they took 50% market share, right? So we don't think there's any business in our company where a new business could enter the space and capture 50% market share. What we find is difficult to replicate in the handset environment is really the technology that makes us want to have a handset in the first place. We want to call, we want to shop online, we want to scroll and watch videos. Thank you, Qualcomm, right? So it's the chip manufacturer. It doesn't matter who happens to be winning the current popularity contest in handsets, they're all going to have Qualcomm chips. That's not to say that Apple hasn't evolved its business over time. It certainly has a lot of good ecosystems, subscription-based model products. And so we have full model on Apple. We would have to have a full model on Apple in order to be able to build out a forward-looking model for Qualcomm. How many chips is Qualcomm going to sell to Apple? So we need to understand Apple's business, but also then there's going to be a valuation view for us before it comes into the portfolio.
Despite being sector agnostic, roughly 70% of the strategy is invested in comms, consumer and tech. Why are companies in these areas so appealing right now?
As a bottom-up fundamental investor, our sector weights are purely a byproduct of the bottom-up stock selection, so we don't have a view of a particular sector. So, and of course, we're buying companies when they're selling at a discount to intrinsic value. So the cheaper those companies are, the more of them we're going to have, if that's the way it happens to work out. And we also aren't looking at it as right now, right? Because we've got that 8 to 10 year holding period. There are sectors that just don't tend to meet our quality characteristics. Another way to think about quality companies would be that they're differentiated. They own intellectual property that's very difficult to replicate, whether that's a pharma company or a tech company or even a consumer company. And if you look at sectors like utilities, not a lot of differentiation. If you look at sectors like commodities, they're really supply-demand sectors, so it's not about structural drivers of growth. I mean, there could be a structural driver of demand, but still it's a price-competing sector, so it's not going to be a structural growth driver because they compete on price. You could see energy companies, exploration, extraction don't really meet our quality characteristics. Perhaps a oilfield services company might. And then industrials, we look for companies where we see the future growth, So, we own a company like Deere, for example, that's an industrial company because we see the long-term structural driver of growth for Deere, which is, just to sort of tie that in a package, Deere is a cyclical company. We're not buying it just for the cycle. The cycle in a company like Deere happens through how good the crops are. The better the yield, the lower the commodity price. So a trough for Deere would be when yields are really good and farmers' revenues are low and they're not buying tractors. That's a good entry point for us, for sure, because we know that's temporary. But we're not buying it just for the next upcycle. We're buying it because if you look out long-term over the decades, we can see that by 2060, population on Earth is going to increase by 1/3, but the demand for grain is going to double, and there's no more arable land. So the structural driver is meeting that demand with ever more efficient agricultural tools that can increase the yield.
Could you now share a couple of stock names that you currently love and explain what makes their business model so special?
I guess I'd start by saying we don't love anything.
It's probably the best.
But I can add some color to that. I mean, we are looking for businesses that, it's not that we want to own them for a long time. We want to own the kinds of businesses that can be resilient regardless of the changing macroeconomic environment. And if we find that kind of company, then we will be able to own it over the long term. So I think what I would like to show, the ones that we love the most right now would be the ones that are selling at the deepest discount to intrinsic value. So the greater the disconnect from what we think it's worth and where the current valuation is, the bigger our position size. So yeah, we love having conviction in our names based on our deep research. We actually did a study of Amazon stock price over the 19 and a half years we've held it. It'll be 20 at the end of this month. And there have been 14 drawdowns of 20% or more over that period. Some were 35, some were 45, one was 60, so significant drawdowns. But if you held Amazon stock the entire time through those drawdowns, you outperformed the Russell 1000 growth tenfold. So you really have to understand that long investment time horizon, the resiliency of those businesses, their ability to generate cash, reinvest in their own future growth to sustain their leadership. And that's what we're looking for.
Okay, time in the market, as they say.
Time in the market, stay the course.
Yep.
For sure.
So, okay, well, outside of Amazon being, an almost 20-year holding, can you also talk about perhaps a recent addition to the portfolio?
Yeah, the most recent addition to the portfolio was Ferrari. And Ferrari, I'm sure everyone knows, Ferrari is really the preeminent luxury vehicle, sort of the super luxe vehicle that's out there. Obviously, they have a great brand. They also have great market share. When you look at their market share for that super class, they have more than 30% market share. They have fantastic pricing power. The brand is so strong and the pricing power is strong is because they actually cultivate scarcity, right? So they always manufacture fewer cars than there is demand for. And then it's hard to buy a Ferrari, even if there's one available. You can't just walk into a Ferrari dealership and buy a Ferrari. If you want to get the latest and greatest Ferrari, you probably have to own one or two Ferraris first. It's not just first come, first serve. We bought the stock because the company's been under some pressure. Luxury broadly has been under pressure. They had some other production issues that concern short-term investors. So we saw it as a sort of great period or a great price at which to buy Ferrari because there were some short-term headwinds. So the price was already low. It's gone even lower. It's all upside optionality from today's price anyway. So it's not a structural change to our long-term investment thesis. Everything remains intact. And the price is very attractive.
I'm fascinated by your sell discipline, specifically that you track every single position that you've ever sold to see if your original thesis played out. What ultimately triggers you to let a company go, and what have you learned from tracking those exits?
I think just framing our buy-sell discipline very briefly is that we scale into our positions and we gradually scale out. So when a stock price falls to, we call it bear or worst case scenario, meaning it's fallen below what we think it's actually worth, we will typically initiate a position with just 100 basis points, 1%. And then if the stock price goes down, which we kind of hope it does, we will add some more. So it could take us a full year to build a position. We will also gradually scale out. So as the stock price, I could say if the stock price, because some long-held companies continue to have a deep discount to intrinsic value, but as the stock price starts to climb toward intrinsic value, we'll trim it, right? We want to have less exposure because there's more downside risk and less upside potential. So we right-size that position, and then we can take the cash and invest it in something that's more attractively priced. So by the time we're finally selling a company, we may have been trimming it for a year and a half or 2 years. And a trim doesn't mean we're selling it. But by the time we are selling it, the median position size is usually 60 basis points, even if it had been, 6% position size at one point. So that sort of frames how we buy and sell. So when we say why we sell, reached intrinsic value, better reward to risk, or incorrect investment thesis, just 3 buckets. So reached intrinsic value is the happy outcome. We finally sold the company. A better reward to risk. So reward to risk is the upside relative to the downside. So we want things that have a high ratio in that regard, 2 to 1, 3 to 1, 4 to 1. So we might sell something that has a 2 to 1 for something that has a 4 to 1. So nothing wrong with the company we sold, we just found something that was more compelling. And then incorrect investment thesis, that's what compliance makes us say, mistake. There was some sort of mistake. And so basically there's 2 aspects to that. We identify the mistake and then we determine what the best exit strategy is. But I think what we do beyond that is we track every single sell to measure whether or not that stock is underperforming the portfolio. Because if we sold something for any of those reasons that's outperforming the portfolio, we made a mistake. So you can imagine, we look at it over 1, 3, 5, and since sell. And over a 1-year period, you could imagine that a reached intrinsic value may outperform the portfolio because we're going to sell as the stock price is going up. By the time it's reached intrinsic value, there's some momentum in that stock. But by 3, 5, 10 years, that shouldn't be the case. And so what we found is looking at the cumulative returns of all of our sells, it's probably about 60 in the large cap growth and probably about 12 in global growth. The cumulative returns are around 300% over the 20-year period. And for the batting average, meaning how many did you get right, how many did you get wrong, in the global growth strategy, we have a batting average of 92. And in the large cap growth strategy, we have a batting average of about 88.
Okay. And how many stocks in your portfolio at the moment do you currently hold?
45 companies are held in the global growth portfolio.
Okay, interesting. All right, so final question.
Yeah.
We're currently living through a time, obviously, of incredible disruption and dislocation. How do you believe the market shifts we're seeing right now are actually setting your fund and your investors up for success in the future?
So we are able to, through our discipline, add to some of these companies that are being, we believe, sold off unnecessarily. We think there's been an undifferentiated sell-off in software companies, thinking that there's a SaaS apocalypse. I think the market's starting to recognize now that, it's not a broad brush stroke, that, every software company is facing an existential crisis because of AI. But during that weakness, we were able to add to some companies on price weakness. We added to Microsoft, for example, which we hadn't added to in many years. So, always staying vigilant to making sure that the companies that we have are resilient for the future, are positioned for the secular growth, and are selling at a discount to intrinsic value. So when you look at the portfolio overall, the portfolio is selling at about a 45% discount to our estimate of intrinsic value. And when you look at the growth, this would be our proprietary cash flow growth, 5-year annualized forward-looking cash flow growth is close to 20%. So that's the positioning we have for our investors today. And we buy when prices are down. Never a bad idea to buy the dip for our portfolio.
Of course.
And stay the course, as you said.
Yes. Thank you so much, Hollie, for sitting down with Livewire today, and enjoy the rest of your time in Sydney as well.
Thank you so much.
If you enjoyed that interview, give it a like, and don't forget to look at our YouTube channel for more content like this.